Hello, I'm joined in the studio today to discuss the outlook for 2017 by Dominic Rossi, the Chief Investment Officer for Equities at Fidelity, and by Charles Mckenzie, the Chief Investment Officer for Fixed Income. Thanks very much for joining me today. We're talking a week after the US presidential election. Dominic, what was your reaction to the Trump win and the impact on equity markets?
Well, surprise. Firstly, I was surprised that Trump did win, and secondly, I was surprised that the sell-off in equities only lasted a few hours, and very soon domestic investors particularly focused on the growth strategy of Trump, which is certainly there, and that turned the market around literally by midday.
So, I mean, almost the reaction was maybe not what you would have expected. It was positive equities, negative fixed income. Charles, what was your take on it?
Well, again, surprise, and I think the markets were surprised by the result because it wasn't being discounted at the time. And I think there's certainly been a significant reaction, in particular in the US Treasury bond market. So we've clearly seen quite a bear steepening of the curve with effectively yields backing up towards yields that we haven't seen since the beginning of the year in US Treasuries. So quite a violent reaction in US Treasuries.
So when you say bear steepening, you mean that the long-dated bonds, the yields have risen?
Yes.
And that's a reflection of fears about inflation, is
Well,
it?
there are two things, effectively. There is a concern about there's going to be a real reflation in the US economy driven by fiscal policy, so driven by much greater supply of government debt. So because of that, greater supply going into the long end and concerns about inflation meant that longer dated bonds have underperformed in that environment.
Yeah. So inflationary worries, I guess, are part and parcel of a growth story that you talked about, Dominic. That's good for equities, isn't it?
Yes, I mean, I think the assessment of capital markets seems pretty reasonable at the moment. They're making the assumption that there are going to be a lot of treasuries, so treasury prices have fallen, and there's going to be more growth, so time to buy equities. There's also another angle to the equity story in addition to the growth, deregulation in a number of areas. Financial stocks and healthcare stocks have responded positively to that possibility, and also the corporate tax cut will be a significant boost, if it happens, to S&P earnings. And that could take S&P earnings up from 121 this year to maybe 140 next year, as opposed to 128. So a very significant increase in corporate earnings are on the cards if Trump does deliver what he thinks he's going to deliver.
And what you're talking about there is US equities, isn't it? Because clearly this is not a good story across the board. Emerging market equities don't look quite so attractive.
Well, the other part of the Trump agenda, of course, is America First. And we don't quite know what America First means. Does it mean just hard bargaining, or does it mean putting up fences and putting up drawbridges to world trade? Naturally, emerging markets, many of them are export-orientated economies, are very dependent upon those exports to the United States, and that is seen now as an Achilles heel to many of those economies.
Charles, let's just go back to the bond market. I mean, there's been some fairly wild talk in the last week or so about the end of a 30-year bull market for bonds. Is that taking it too far?
I think it's very much taking it too far, and I think people are sort of jumping onto the sort of worst case outcome as far as the bond market is concerned. There's understandably been a reaction in the bond markets, but it's very much to do with a reflection of a huge amount of political uncertainty we're now facing within markets. We've got obviously Brexit, what that means, but obviously in particular the Trump policies. We still really don't know what Trump policies are going to lead to. What we do know clearly is that there's going to be some fiscal expansion. We're not exactly sure what form that takes yet. It seems as if a majority of that expansion will be through tax cuts, but a lot of those tax cuts are going to be geared towards higher earners in the US economy, and therefore we're not really sure yet as to the multiplier effect that has in terms of US economic growth. So there's an awful lot of uncertainty still around the Trump policies, and of course we are still faced with significant structural headwinds to global economic growth, which is still a good environment for fixed income.
Now, you mentioned political uncertainty there, and obviously this is not just about the UK or the US. We've got a lot of elections coming up in Europe. Is that something that worries you, Dominic, as an equity investor, that political uncertainty in Europe particularly?
Yeah, I think it has to. I mean, first of all, we've had two elections, a plebiscite on Brexit, obviously, and the presidential elections. Both of those went against the vein of current opinion, and with risk that had to then be priced into markets. That's going to increase the sensitivity around forthcoming presidential elections in both France and in Germany. And I think the fact that the populists vote for both Brexit and for Trump also is going to raise expectations that maybe that will be repeated possibly in France in April next year.
Okay, so bit of uncertainty, or quite a lot of uncertainty over the next 12 months. Is it a good year for equities, good year for fixed income, or a bad year?
So I think it's good for equities. The very likelihood is if we get the stimulus that I think we're going to get now, it should be a good year. Growth will certainly be on an upward trend. And with the corporate tax changes, particularly if they're retrospective to the start of 17, could mean we'll have a very strong year for corporate earnings.
And the bond view?
I still think it's far too premature to call the end of the bond bull market. I still think central banks are still very much in play as far as the financial markets are concerned. We're likely to see Fed increases, Fed rate rises during 2017, but they'll be limited of nature. And we will still certainly expect the ECB, the Bank of Japan and the ECB to be stimulative for global economies. And that's still always going to be good for fixed income.
Charles, Dominic, thank you very much.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书或投资人须知。